Fears of a prolonged war in West Asia keep markets around the world on tenterhooks. The Sensex and the Nifty fall 3 percentage points this week to clock its biggest weekly fall in over a year. Financials feel the pain and they were the biggest laggards. The Nifty Bank saw its biggest weekly fall in 14 months. Over the course of the next 30 minutes, we'll decode what this war means for Dalal Street. We'll put the spotlight on India's macros, the currency. Hello and welcome to Editors Roundtable. I am Reema Tendulkar. With me are Nimesh and Lata. And joining us here in our newsroom is Rajesh Kothari, MD of Alf Accurate Advisors. Hi guys, it was a short week, but an extremely challenging week. You know, out of the 4 trading days, in 3 of them we closed in the red. In Friday, there was this late sell-off which dragged the markets down, and indices ending the week with about a 3% cut. And everyone thought at the start of the week that maybe this is going to be a short, it won't be a prolonged conflict. There'll be buying which emerges because of past history, but nothing of that played out.
Oh, absolutely. So I think the only good news this week was that we are in the finals of the T20 World Cup. So I think that's the only positive. Otherwise, it's been a challenging week. And as you rightly pointed out, right? I mean, nobody thought this will prolong for more than a few days. And now it's getting dragged and dragged. So I guess that's what
there was one more positive. Tuesday markets were off, you know.
Oh, yeah. But it didn't feel like...
But a lot of brokers, by even anchors, who were of the view that good, it is closed on Tuesday. By the time we come on Wednesday, everything will be settled. I mean, we were as optimistic as that.
Yeah, at least less damage, one lesser day of a damage.
Yeah, but it came with double force on Wednesday. And this time, all the macros are in trouble.
Oh, yeah,
I mean, you are going to have a problem. We were very happy that we have growth higher than expected. You know, GDP after GDP. Yeah. We thought we had inflation lower than expected, even with the new series. Now, all those go for a toss. Growth is going to be lower than expected and inflation is going to be more than expected because of this unexpected supply shock that we will face.
Yeah, and I remember at the start of the week, Jeffries had put out a note saying India's dependence on Middle East is very high. It's 17% of India's exports, 55%, it provides 55% of India's crude oil and 38% of worker remittances. So the fact that it, prolongs, and this week we've seen crude prices go up 18%. It was at $72, $73. Now it touched $85, $86 per barrel. So all that, Lata, is really hurting the macros.
Oh, yes. I think until now, I used to always ask experts like you the question, India's GDP is doing very well. Why are earnings, not catching up? I can understand for 1 quarter, 2 quarters, 6 quarters, 7 quarters, Nifty in single digits. When growth is at 8% used to be my question. Now that boast has come under a bit of a cloud for all the reasons that you said, our dependence on the Middle East.
So this is exactly what I asked Ramdev yesterday, that, he's been a big advocate of that the earnings will pick up and he's expecting 14, 15, 16% earnings for next year. And with this kind of, macro backdrop and the crude going higher, is that going to challenge the earnings backdrop overall? And he expects that, maybe it'll trouble the earnings as well, because a lot of the earnings will get impacted, especially the OMCs and all those guys, Reliance and everybody. So, Rajesh, your thoughts? What's your take?
I think it has been about 7 days of the war. It is not prolonged war, It is still short war, correct?
Correct.
So, and we hope that, and I think this time the fight is against the might. Yeah. So outcome by and large, everybody knows, correct? The only thing is what is the duration? Will it be 1 week? Will it be 3 weeks? Will it be 4 weeks? And he has given official statement of 4 weeks, right? But the important thing is that if you look at the third quarter numbers, because after the noise finally come back to data point, what is the data point suggesting? And I was looking at the entire third quarter numbers. You look at consumer, you look at capex, you look at credit. So you look at consumer. Most consumer companies deliver double-digit growth. Look at Phoenix Mall, the largest mall of the country. You have 18% plus growth. Yes. Correct? Look at the total credit card transactions of the country. Yeah. It's 18% growth. In capex, look at L&T order intake growth. It is a strong double-digit, 20% plus. ABB reported 30% plus.
Okay, let me stop you there.
Yeah.
What's your view on L&T itself? Because they have about 55% of their order book exposed to the Middle East. All that you are giving me is historical legacy data, which is already in the price.
No. What I'm saying, the order intake growth. So what it suggests is...
will they be able to execute?
That's what I'm saying. Order intake growth, basically what it suggests the economy is back to its momentum, which it was missing 6 months.
No, I'm taking all that. I mean, I'm on your side when you speak about growth. I'm just asking you pointedly because this particular company is exposed.
Yeah. See, what happens, Lata, whichever company gets exposed, correct, their earnings definitely will be under question mark in terms of the 1 quarter or 2 quarters, depending upon how prolonged this is, am I right? And therefore, the stock is already down. The point is, from here, what you do, am I right?
So what do you do?
That is my question.
So they basically, people will look at just like COVID or during Russia-Ukraine war. Whichever companies got impacted, their stock price on day one goes down, correct? And then you take FY27 full year view and the existed price. And that's somebody's view. Suppose somebody thinks it is going to be 6 months war and L&T will not able to execute and Middle East will not allow any company to execute, which I don't think is possible, am I right? Because finally the Middle East and they are also strong countries, am I right? So till now, till as on yesterday, correct me if I'm wrong, I'm sure you also must be speaking with many managements, there is no major impact on actual execution on ground.
Yeah.
That's a fact of the life, am I right? And stock prices have come down. So the valuations, of course, are turning in your favor. And definitely after 1 month or after 2 months, it is back to normal. Question is 2 weeks or 4 weeks. That's a question which is in everybody's mind.
So have you deployed money this week? If
We are
yes,
deploying. We are deploying.
Aggressively deploying
We are
this week?
deploying. I think this is a time to deploy. Because you will never able to time. Look at like India,
What kind of sectors would you
I tell you,
choose?
for example, India, Pakistan. One headline on Sunday, 4 p.m., ceasefire, done. So you can't predict when there will be ceasefire, am I right?
Yeah.
So important is 3 sectors. What we like is auto is one sector which will do extremely well. Of course, crude oil is a risk, and that's why you are seeing some correction. But in my view, the actual petrol diesel price will not go up. OMC will take the hit. So anyway, we don't buy OMC. So auto will do well. Banking and finance, some right now inflation worry because of again of crude oil. If it comes under correction, it is a strong bad decline because credit growth, and I'm sure, I mean, you are expert. The credit growth is back to 13% compared to 8.5%. So that is good, and asset quality anyway is best, correct? And the third, capital goods, selectively, companies which are reporting very strong order intake. These are the strong sectors. And last but not least, the hospitals. They have nothing to do with this war. Hospitals will continue to do well, right? So these are pure strong India stories. And these are less impacted because of these macros. Who knows how the macros will turn out, but it will be much lesser impact.
Hospitals are not even affected by AI disruption
Absolutely.
also.
They are not impacted by even AI disruption. Even your auto is not going to be disturbed by AI. In fact, they are beneficiaries of AI.
Yeah, they would actually be more perhaps productive.
Absolutely, because their cost will come down.
Cost will come
I was speaking with one of the chairman of the bank, and he said because of AI, our cost to income ratio, you should not surprise if it reduces by 200 bips over next 2 years.
Over what, 2 years?
Yeah, which is big because directly it goes to your ROE and ROA, and which we are not even right now. Entire AI is AI losers. But AI beneficiaries, the banking, the few consumer companies, few large cap goods companies, we are not even factoring that.
Yeah. We were chatting with one of the managements and they said that, while there are productivity gains, etc., as you pointed out, the cost of compute is also very high. So that is something that you have to keep a check on.
Absolutely.
So you may not realize the entire benefit of it.
See what happens, that will go into CapEx. And CapEx gets spread out over 5 years, 10 years cycle. So it is a 0.001% impact on depreciation. But your employee cost reducing directly hits your P&L, it improves your P&L, so your ROE goes up.
Okay. So autos, banks, capital goods,
banks,
hospitals, these are the 4.
Consumer discretionary will do well, extremely well. Premiumization will keep doing well. I mean, and all these are fast frequency data indicators.
I could see this yesterday when I went for the match. I mean, it didn't look like, markets are struggling so much or there is a job loss or 50,000 people, a lot of the big guys coming in fancy cars. People are spending on food, people are spending on tickets. I mean, the tickets are not that cheap, right? I mean, some of the tickets were like for 20,000, 30,000, 50,000 tickets. So, and people are spending. Not everybody gets a complimentary ticket, right? So, I mean, 50,000 people are spending one night, 4 hours for a match and spending so much of money. I mean, it doesn't look like...
there's no denying that. Look at the way the hotel stocks did. I mean, even if the stocks had already priced in, the numbers that came at the end of the third quarter were outstanding numbers.
Very high.
Clearly showing the premiumization and consumer discretion. What would you avoid? And let me ask for one specific sector. We spoke with former chairman of BPCL and GAIL today. And the big question was, even if now crude is kind of made available because of Russian oil being available to us, what happens to cooking gas? And their reply was that we are only dependent for about 1/3 of our gas requirements, natural gas,
Correct.
from the West.
Correct.
And their guess was, West as in West Asia, their guess was that the government will prioritize and not allow industrial use of natural gas till the war ends and only concentrate on cooking gas.
True.
So can there be any sectors to avoid because there may be a gas shortage?
So I think the impact you will see across sectors, particularly depending upon which region you are. For example, Gujarat, Morbi, tile sector already getting impacted. Now, if the impact is for 5 days or 1 month, that somebody's, I leave it to somebody's judgment depending upon the war, am I right? But these are the sectors which are heavy gas consumers. Probably these are the companies rather than sectors which you need to avoid. Means you can't say, I will not buy consumer because somebody is going to hit on tiles. So then probably you can avoid maybe the tiles sector because short term might be a little bit challenging. But so generally we do not prefer OMC companies. And anyway, rising crude oil is not good for OMC companies. And of course the AI fear. So that is the sector which one needs to little bit underweight.
So that would be what, IT?
Entire IT, and unfortunately the platforms got impacted in a very big way. Not only IT. There are so many good platform companies in India across the sub-segments. That also got rogered in last 1 month.
You would pick some of them?
Very selectively, extremely selectively, because what is happening, the intelligence, just intelligence and intellectual will not help when you look at the entire sector. So we spoke with one of the AI expert last month, one of the top 3 companies in the world, and they said that only somebody's intellectual, that cannot be the barrier, because now AI is doing that job. So you need to be more backward integrated, that you need to actually own the customer. Just providing good software front will not help. So in platforms, there are only 2, 3, 4 companies which are actually very strong, who owns the customer. They provide actually the package, just not the fancy
just not one plug-in software.
Yes, it is just not marketplace. Just marketplace may get disrupted.
That's true.
So, interesting. Very interesting insights, Rajesh. But Lata, the rupee, with the fall in the markets, the rupee is also in a free fall.
Well, this year and maybe February to now, the rupee is an outperformer. The other currencies have fallen more. But of course, you have to look at it over a range, and the rupee is in trouble. This week itself, it was saved only by tons of dollars sold by the Reserve Bank. Numbers, of course, this is all chatter. You'll never be able to get the correct number till the final numbers come in the RBI bulletin. 5 billion a day, is the amount that Reserve Bank is believed to have sold across. I mean, they don't sell it in the spot, NDF market, as well as futures, that is sell by swaps. All those put together, that is the massive amount of, selling they've done. But I just want to point out some data on why we should be what are the numbers that we should be worried about? The balance of currencies in the country is made up of current account flows and capital account flows. Now, current account, we normally have a deficit because as a country, we import more than we export. Of course, the deficit has been declining because we are exporting services. As well, we have remittances coming from abroad. But even then, we are a current account deficit, but capital flows were positive. Now, the table is running by, Rajesh, you cannot see it, but for the viewers, and the table will show you that balance of payments, current plus capital, has started to turn negative. And for the first time, 2 quarters in a row, that is the quarter ending September and quarter ending December, we had negative balance of payments, which means capital flows were not enough to manage the current account deficit. And this is likely to be the 3rd quarter. 3 quarters in a row, we have not faced in a long time. 2 years in a row, we have not faced negative balance of payments in a long time. So this is something to be worried about. And, the FPI flows are also something we are showing on. And all of you know those numbers by heart. Again, there have been 2 consecutive years of FPI outflows. And that is a weight. This was the state of the currency. And I have done these explanations so many times up until February end. And into this, we are now adding a very big negative. We were already in a negative BOP, and now you're adding a serious current account deficit factor, which is higher price of oil. Now, whether you and I don't pay at the pump or someone else in India is paying, the OMC or whoever. So India as a whole will have a bigger trade deficit, a bigger current account deficit, a bigger balance of payments deficit. So the rupee is not showing a very pretty picture. No. It's not round the corner that things are going to improve. In fact, you will tell us better. When will the FPIs come back? You tell us.
I think I always believe that अगर आपका flower में सुगंध रहेगी तो मधुमक्खी आएगी. So if your corporate earnings growth picks up, the investors will come. Be it local, be it FPI, be it hedge fund, somebody will come. So if you look at the Nifty earnings growth, which was 5%, FY25 will become 9% in FY26. Third quarter, if you look at the BSE 500, earnings growth is already 13%. Okay. So we are back to double-digit earnings growth in third quarter already. Next year, the Nifty earnings growth is going to be 15 to 17% as per conservative estimate. Okay. Because the banking sector, which has reported zero growth because of 6 months transition net interest margin, that will basically contribute to the much higher growth in FY27. So BSE 500, excluding banking, excluding metal, aggregate all, in all respects, the third quarter has been already double digit. And that's what I'm saying. The fast frequency data indicators are showing very strong positive momentum. Of course, you have this macro headwind is there against you, but otherwise all data points are, I mean, this for after a very long time, we are seeing all macro positive data.
So your bet would be that FPI flows should resume?
FPI flow should be resumed because the, the other countries also will start becoming more expensive. Particularly China, particularly Korea, the Taiwan, where the flows went last 18 months, that also there'll be, yeah. So
let me flip it in another way and ask you, are you worried about the domestic flows? Because that was the leg which was helping the markets to float, right? And for the last 18 months, the returns are negative. There's a bit of frustration now that, my money is not making money for me.
But it didn't show up in the Jan numbers, no?
It's still not showing up. The problem is that will it show up?
Financial
is there something that is picking up?
See, I think investors have understood that any buy is always a good opportunity. Yeah. Any decline is a good opportunity to buy.
That's worked in the past, but it's been almost 2 years now that there is zero return.
Ultimately, on a greed and fear pendulum. Yeah. When others are fearful, you have to be a little bit greedy.
What are we right now? Are we in a very fear phase that one should be greedy?
I think we are at fearful phase. Because 9 out of 10 people are not talking about equity. They all talk about gold, silver, China.
Exactly.
People are floating global funds from India.
So time to buy is time to buy.
I think it's time to buy. One can do staggered approach. Sure. One can say spread it over next 30, 60 days. One can say I will wait for full certainty. Okay. But yesterday when I was speaking with one of the large family office, he said in Gujarati line, that Sara Bhav and Sara Samachar Sathe na ave.
Correct.
The good news
and good price come together.
Never come together.
Yeah, absolutely.
So it is up to you. You want good news, then you have to pay price for it. If you want good price...
Actually, that's a great sentence on which to take a break.
Yeah, indeed. We'll slip into a very short break. We'll come back and continue the conversation on Editor's Roundtable. Don't go anywhere.
I don't walk, I cruise. I don't sit, I lounge. I feel fresh. Hot meals bring a smile. I found my place in the sky.
CoinDCX पर जा और रिसर्च कर. क्रिप्टो इज रिकॉग्नाइज्ड एज अ वर्चुअल डिजिटल एसेट. क्रिप्टो नया है पर उसमें इन्वेस्ट करने का तरीका पुराना होना चाहिए. इसलिए रिसर्च, अंडरस्टैंड एंड इन्वेस्ट on CoinDCX, India का crypto coach.
Crypto products and NFTs are unregulated and can be highly risky. There may be no regulatory recourse for any loss from such transactions.
अरे टेंशन किस बात की? सेंचुरी प्रोवुड का प्रीमियम प्लस है ना. लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है. यानी ये है जहां नो टेंशन वहां.
प्रीमियम प्लस बाय सेंचुरी प्रोवुड.
Welcome back. You're watching Editor's Roundtable. Markets in India collapsed for the second straight week. This week, the benchmark indices were down nearly 3% as West Asia tensions continue to escalate. We've been in conversation with Rajesh Kothari of Alf Accurate Advisors. So Rajesh, we just ended the segment saying that good news and good prices don't come at the same time. And you already told us stocks that you like.
Yeah.
Right? Can you tell us a little bit more about auto and auto ancillary? Because it's a broad segment. You've got two-wheelers, CVs, passenger vehicles, tractors. What do you like? And what is the risk of rising inflation on the margins? Can that derail the auto story?
So, well, if you look at the recent February number as well, third quarter has already been very strong. Then you have January numbers, then you have February numbers. In Maruti conference call, which is the largest car player, am I right? He's saying that the inventory is one of the lowest of last 2.5 years. You look at the second largest two-wheeler player, TVS, has reported already 20% plus volume growth. Correct? Please put a disclaimer because we are holding these companies.
Both Maruti and TVS.
Yeah, so please put a disclaimer. These are not recommendations.
But Maruti, for instance, has exports to Middle East, right?
Yeah, but export is small. They have export to a number of countries. Middle East is only small. Africa is much bigger. Even for the two-wheeler players, Africa is much bigger.
But there will be an impact,
then,
right?
10 days अभी तो हुआ है, अभी तक तो impact नहीं है. One month impact is not an impact because please remember, always think about, is it a postponement of demand? Is it a demand issue or is it a supply issue? If it is a demand issue, you need to be worried. If it is a supply issue, don't get worried because then becomes postponement of demand. So then order book will be get built up. Correct? Like COVID time, demand was never a problem. Supply was a problem. So then it became 6 months order book. Correct? The stock price don't get impacted. So always there will be impact on the numbers. But the second month you will see double numbers.
Rajesh, what about power and metals? Metals have obviously seen prices running up because aluminium producers in West Asia will have to, were threatening to close down or could not work. So metals is one question and the other one is power. I mean, there is a fuel problem, so coal is now becoming again precious. Global coal prices have gone up. Any thoughts on companies like Tata Power or Coal India?
So what is happening is globally, there is a thought process that because of the hardcore infrastructure needs to be put up, there will be more requirement of metals. And that may lead to the higher metal prices. And therefore, in turn, it will lead to the better stock prices. That's basically the view globally. Because metals are finally global companies. When it comes to the power side, the power demand, because summer is likely to be a little bit hotter than what, as per the IMD is going to be
talking about El Nino.
Correct. So there is expectation that the power demand also will be a little bit better compared to what the initial estimates are. So then you need to look at the company-wise, the merchant power,
so where are your bets? Which part of the power side?
Right now we do not have any large exposure to power sector because these are temporary periods, 2 months, 3 months effect. We always believe to
But you own, I guess, the transmission businesses. One of those few of the transmission
prefer the product businesses. The
T&D
plays,
and
the companies
T&D.
Correct. So those have nothing much to do with the power and coal India and all that stuff because they are actually much more bigger hyperscaler play, the data center play, the metro capex play. So they are immune to this, both sides, good and bad. They are much more structural story for 3, 4, 5 years.
The one thing in the broader market, you spoke about the broader market earnings been quite strong in Q3. In that sense, what are going to buy in the broader market names? If you can identify a few sectors or a few companies that you like, you've been tracking and it's just fallen because of this war-related issues.
So I think strong stocks have not fallen much despite this macro war issue. So auto ancillaries, if you look at it, there is not much significant decline in auto ancillary, but there is a strong buy declines. I think few NBFCs that can become a very strong play. Consumer discretionaries, hospitals, specialty capital goods companies, one or two specialty chemical company which goes into the data center cooling agents. So these are within niche business. So I think more bottom up probably will work in FY27. Top down the sectors will do well, and then bottom up you need to do the individual sub-segmentation.
What are your preferences? I'm asking you sectorally, but you can tell me stock-wise. Private sector banks, public sector banks, NBFCs. Which is your best preferred?
So I think the commercial vehicle financiers will do extremely well. And the growth will be very high because CV cycle is just turning up, so which is good. If you look at the private sector banks, 1 or 2 private sector banks will do well, not everybody. 1 or 2 PSU banks will do also extremely well because they have the best of the ratios in their favor. And there, if you look at the capital adequacy ratio, as well as CASA, as well as loan to lending CD ratio, they are also favorable. Whereas for private sector banks, they will limit on the CD ratio. So that is actually putting incremental pressure about how much you want to grow. That becomes a little bit capped. So NBFCs, I think, will do also well. CV within that will do better. And few private sector and few PSU, but you need to be selective within each of that bucket.
Many of the Gulf countries also control large sovereign funds, whether it's ADIA, Mubadala, Kuwait, Qatar, etc. And they make large investments in infrastructure, tech investments, real estate.
Correct.
While I get higher crude prices will bloat the overall Gulf economies, but there is also the possibility that the government calls on these sovereign wealth funds to divert some money to the government. I mean, have you given any of this a thought, how it impacts public-private markets?
I think their financial position is not in a bad shape. That's why they have a huge sovereign fund. They are investing into the other countries.
Correct.
Am I right?
But we're also all dependent on them.
And where they've invested highest is US and not India. Am I right? So if something happens, it might be bad for the US economy in general, but then they both are partners, am I right? So I'm sure they will balance it out somewhere. Nothing much as an India impact. Because there's a large investment they have made in most of these companies are US. The Indian investments are not too big.
Not too big. All right. Okay. Very interesting. Yeah, one more.
No, just overall comment. You are a mid-cap, small-cap king. So you think they are now better placed than Nifty or the other way around?
So as I always say, we look at the profit size rather than market cap.
Okay.
So the 1,000 companies, first 1,000 companies is a segment where we are extremely bullish. You'll be shocked to know that the Nifty mid-cap index, the average profit size is 1,000 crores.
Oh.
Nifty small cap index, average profit size is 400 crores.
Okay.
And they're still called mid and small.
Small. Fair point.
Their debt equity has become 0. Their ROE has become 15%. And their earnings growth is 15% plus.
Okay. Fair point.
So I think they have transformed in last 10 years. They are no more, small is no longer small. Actually, if you look at top 1,000 companies, they have actually evolved. They have become much bigger. And they become
it's a very, very convincing argument. Irrespective of the problems, individual companies have done very well.
That's where I think always alpha is to be made.
All right. Thank you very much,
Thank you so
Rajesh.
much.
This has been a great conversation, very insightful. Lots of learnings for all of us.
Thank you so much for this opportunity. Really, I love the interaction. Thank you.
All right. Well, that brings us to a close in this edition of Editors Roundtable. Don't go anywhere. More news and updates will follow on CNBC TV 18. Thank you for watching.